So the first two you can do in Excel. So this is going to be really tricky. The whole class can't do Excel at once. So bring your laptops. I'll try to bring mine. We'll have the computer in the room as well. The only Excel you'll have is the Excel I'll put on Canvas. So you'll open that up. So let me show you what that looks like. So you'll get an Excel that looks like this. I have the same question in it. In the Excel, it will have the two formulas, but it won't have the correct interest rates in years. All right, so let me start with this first question. Hopefully you remember Excel application 2, but let's refresh just because it's been a while. So remember on the interest rate, you put in the rate for the period of time. So this is monthly payments, and y'all let me know if you're not seeing what I'm seeing, if I get off on a tangent, so let me know. So this is monthly payments. So monthly, you have an interest rate that is 0.0672, and it's monthly, so you divide by 12. It was weekly, divide by 52 or whatever that is. Usually on weekly, I'll tell you that there are 52 weeks in the year, so you know the divide by 52. But that gives you the interest rate on a monthly basis. So it's 672. How many periods of time? Where it's 20 years monthly. So again, here you do the 20 years and it's monthly. So here you multiply by 12. So an interest rate, you divide by the number of periods in the year. On the time, you multiply. Now here it says years in the, I don't know why I put that in there. I'll probably take that off on the exam. I don't know why I did that. So the rate on a monthly basis is 0.56%, and there's 240 months, and that gives you the factors. So you got to decide which factor there is. So you're trying to figure out, is he starting with 0 and trying to save money, or is he borrowing money and he's going to pay it off? Well, here it tells you he's going to borrow $2.25 million and he's going to pay it off over 20 years. And so that case, he's going to be doing the present value. Most of my problems are present value. It's possible it's future value. Future value is when you start with nothing today and you're saving money into the future. That was Excel application 1, the first problem. All right, so remember the columns. You have 4 columns here. The first one is time. The second one is beginning balance. And you can use shortcuts like I am. You don't have to write everything out. You have the interest expense, you have your payment, and you have the ending value. So you'll have to type all of this in Excel on the problem, all right? Remember those 4 columns? If it's a present value, it's interest expense and a payment. If it's a present value, it's interest earned and it's an investment. So if you're investing today, starting at 0, you're going to earn interest and you're going to investment. Here it's a borrowing case, so you're going to be using these columns. Your time, you start with 1 month. And yeah, I'll try to get the formatting so it's right. So you start with month 1, and then you just add 1 to that. So you take that 1 plus 1, and you need to go down 240 months. So look at the row and just see 240 somewhere around there. Remember, you can do control and down. You can see I didn't quite get far enough down. So there's 240, control up, control down. Remember, control without the shift just moves you up and down. Control with the shift highlights everything. But here we just want to get to the bottom. My beginning balance is 2,250,000. So I would format it maybe to no pennies, but it's up to you how you want to do that. This column, whether it's interest earned or interest expense, it doesn't matter. It's the exact same formula. You take the beginning balance. If it's 0, then you're just going to get 0 if it's an investment. But if it's a debt, you're going to take beginning balance times the interest rate. Remember to lock it in. If you're on a Mac, you'll have to figure out how to put those dollar signs, but you want to lock that in. And, you know, it's up. You can use 2 decimal places if you want, but that's fine. And then the payment or the investment, if it's a payment, you're going to take that beginning balance and divide it by your present value factor. If it's an investment, you're going to take the target. So you'd have to put the target, what are you investing to, and divide it by the future value. Here, we're borrowing money. So we take that amount divided by the present value. And then the ending value, it depends. If it's a present value interest factor, then you're gonna do beginning balance plus interest expense minus the payment. If it's a future value problem, you're gonna do plus beginning balance plus interest earned plus the payment, because it's all your money. So it depends on the kind of problem. In this case, it's debt, so we're going to take beginning balance plus interest minus our payment, and that gives us everything we need. I'm going to go ahead and use 2 decimal places again. Then you have to do the second line. The second line, your beginning balance is your ending balance. Interest expense, you can copy down. The payment, you can just reference that previous cell. Your payment should be the same all the way down, and your ending balance can just copy down. So the only difference between present value and future value, really the only difference is on your payment, whether you divide by present value or future value factor, and then your ending balance, whether you add or subtract the investment. Once you get the second row set up, you just copy that down. Remember, you just hit that, don't drag. It drives me bananas. I might come over and make you do the problem all over again. Just don't, dragging is just too hard. Just go right here where that little plus sign is, hit that. And so what should your ending value be? Control down. What, anybody want to say?
The total that we borrowed, or I mean zero.
Yeah, it should be 0, right? So there, get 0. So Bill Gates says we did it right. And that's all you do. You save that, and you're going to put it on an assignment on Canvas when you're finished. So we'll let 4 or 5 of you go at a time, and then we'll have you all in one place so I can make sure you're opening just this file and not any other files. You're honor students, but I still have to make sure everybody's doing it correctly. So everybody else will start with problem 3 and keep working, and we'll move it around. So if you're one of the ones doing Excel, don't waste time. Don't sit there forever thinking maybe it'll come back to you if you can't remember, because we do have some time constraints. So, move quickly on it. Any questions on this first one? That's one. Question 2 is a cost-benefit analysis. So on this one, again, I gave you the question, and it's just a matter of filling out the form. So you might put some numbers in here. So your WACC, you might want to have that number somewhere, because remember, with the XMPV, you got to reference the WACC. So here you can see their cost of capital is 7.8%. I've already keyed the amounts in for you, so there's no problem with, someone mistyping a number. So I have cash flows. You got to do everything else. So remember, everything else, you start with time, and we'll do the other columns with time. Remember, the first one is equal to day. And then the first year you add 365 divided by 2, or however you want to do it. You don't have to get it so that it's exactly 11.7. You can do that if you want to. I tend to like to have it exactly 6 months, but it doesn't matter. And then after that, you just add 365. And I like to have them all 7s, so you can adjust. But if not, if you didn't do that, you have it going 5, 7, 1. It doesn't matter. Either way is fine with me. I'm not real picky on that. It makes it easier for me to grade. Everybody does it, so they're all 7s. But remember how that looks. The first time is today, 0 times 0, so that's equal today. The next one you do half a year, because we want to use that half-year convention. And then after that, you just add 365. All right. And so we're going to do the net present value. There you're going to do the equal XNPV. You do the rate. Now, if you wanted to, you don't have to have the rate there. You could just type it, but I prefer to have it there. Bill Gates is telling you what to do. So the next thing you do is values. And the last one is date. And that gives you the net present value. And then you notice here, would you recommend accept or not? Here, you can just type it here. Accept as NPV is greater than 0. Well, give me at least that. Accept and why? Because net present value is greater than 0. I want you to demonstrate to me the NPV rule. NPV rule, and y'all are all doing it in your cases, so you understand it. The NPV rule is if it's greater than 0, accept. The next one is IRR, same thing, equal X IRR. So I should actually give Bill Gates your grade versus you because he's doing all the work. But you start off with the values, then the dates. You don't need the guess generally. So pretty straightforward. Here, I definitely need the rule, except as the IRR is greater than WACC, all right? So that 12.38% is greater than 7.8%. And then the hard part is the payback. And I realize this is really tough. So you want to do cumulative net present value. So you start off with a deficit of 500,000, and then you do the next one equal X NPV. You have the rate, and you want to lock that in, comma, the values. We'll talk about how to lock that in, comma, the dates. And so here what you're going to do is you want to make sure you lock in that first date, the 17th. You don't want to lock in the second date, just in the dollar amount. So you got to lock those two in. So when we copy down, it always starts with row 17. If we do it correctly, the very last row should be 32,380.3 because that is the net present value. And so for the payback, you don't have to do the formula here. A couple of real important things to do is ignore times 0 because it's times 0. So start here, and it's pretty straightforward. If that's still negative, then you need the entire year. If that's still negative, you need the entire year. All right. So the question here is how much of that year did you use? So let's say the change in net present value. And again, ignore times 0. So the change here, so it went from negative 500,000 to negative 300,000. So it added 187. The change here, so it went from negative 142 to positive 30, negative 327 to positive negative 142. And then here, we added 174. The only number we need is this very last one. So what we're asking is we started with a deficit of 142,000. We added 174. So you needed to go 142,000 into that. So here you just do equal minus your deficit divided by how much net present value you added. That's the hardest part. If you get everything else, you get the net present value and IRR, you'll probably get 70% value anyway, so you're there. So it's not disaster, but do your best. That is the hardest part of this problem, is remembering how to do that. But you don't need that fancy if function. If you just remember what you're trying to do is figure out when net present value goes from negative to positive, you're trying to figure out what year was that. So it's year 3, so it took us at least 2 years. And then since we had a deficit of 142, but our net present value increased 174, how much is that into the year, all right? Questions on that? I know NPV is, payback is the hardest.
Yeah, can you take another look at the change in NPV? Is that just the change from our original cash flow?
Well, it's cumulative net present value. You have to do the discounted value. So you have cash flows. You don't look at the change there. You're looking at the change in the net present value. That makes sense? I don't know who asked that, but
It was Carson. It was me.
so
But
Russell,
yeah, I
that
think
makes sense.
so. Yeah.
That's a tough one. I realize it's a tough one, but you know, do your best. But at least I'm not asking you to give me the fancy if function because it's just not really. I mean, you can do it if you want to. If you want to show off, that's fine. But you don't need it here. So, not asking you to memorize a long if function. Any other questions on that one? All right. So if you do this, so here what you say is their payback period is 2.8. So slight reject as payback is greater than 2.8 policy. All right. This is all I need. I don't need you to tell me the overall if you'd accept or reject a project. If you just give me those three things, I'm really just looking, all I'm looking for is that you know the rule. NPV rule greater than 0. IRR rule greater than WACC. Payback rule less than the policy. All right. Okay, so 2 down. So now we'll do this set of questions for 3 through 6. So question 3 is determine the beta for FDX and come up with CAPM. So the question here is, how do we get the beta for this firm? So remember CAPM says that KE equals the risk-free rate plus beta times the market risk premium. So the risk-free rate, remember for the risk-free rate, we use the 10-year treasury. That's 3.4%. And remember on the exam, anytime you're doing percentages, type them as decimals. Some students really struggle with that. Plus the beta, we're going to have to talk a little bit about the beta, times the market risk premium. That's just given to you. So you don't have to actually calculate that one. So I call it equity risk premium. Remember, sometimes I call it market risk premium. Sometimes I call it equity risk premium. Both of them are used in finance. They're interchangeable. That's 4.5%. And then the other thing I need is the beta discussion. The 4 steps. I call it revenue sensitivity. So we're talking about FedEx. Now, you could disagree with me on this. One thing you might do that would make it really easy is look at the historical beta and see if it's above or below 1. Because if you thought FedEx was a defensive company, low beta, you'd look at this chart and say, well, their median is 1.1, so it's above 1. That might help skew you so you don't have to change your opinion once you get to step 4. So this is a firm that's above 1. So I'm going to say is a cyclical company as it delivers packages and consumers will probably cut back on spending during the recession. Something like that, just to show that you know what a cyclical company is. So cyclical, it's manufacturing, it's heavy equipment, it's travel and leisure, consumer discretionary, defensive, it's the Walmarts and grocery stores and utilities. So it just depends on that. Now, if you get that wrong, if I strongly disagree with you, as long as you define it well, so you might think we had a debate on Ross Dress for Less and some other companies we were talking about in one of my classes, and it's debatable. It's a clothing store, but it's a discount clothing store. So I'm looking that you understand what a cyclical or defensive firm is, not that I agree with you that McDonald's is cyclical or defensive. So do your best there. Step 2 is operating leverage. Really all I'm looking here is how volatile is their margins. So the typical stock has a standard deviation of margin of 7.71. FedEx is only 1.92. So, all right, so here you might at the end of this beta above 1. Here, FDX has very low standard deviation of margin. So you might say, you know, it's not 192 versus 771. Implying low operating leverage, lower fixed cost, and thus reducing beta assumption closer to 1. All right, something like that. Step 3, the easiest one of all, is financial leverage. There you just look at the chart and just say, okay, their debt to equity is much higher. I'm not going to put the numbers in here, but FTX debt to equity is much higher than average stock, increasing its beta further above 1. So you got one thing that says their beta is kind of getting closer to 1 because their fixed costs. I would think FedEx would have high fixed costs because they have a bunch of trucks, they have planes, they have unionized labor, but they're somehow able to manage that and keep the volatility of their operating, their net margins low. Not sure how they're doing that, but it certainly implies that it's not a high risk company when it comes to operating leverage, but they do have a lot of debt. And then step 4 is the history. So, you know, the median's 1.1, however you want to talk about that. So you could say median beta is 1.1, but has been much higher lately, maybe due to higher debt. I recommend beta, and there's all kinds of answers here. I might say 1.2 because while the median has been 1.1, they've been well above 1.1. I mean, the median the last several years looks more like 1.3, but your choice. I don't disagree with you unless you came up with a beta of 0.4 or a beta of 2.5. That would be pretty crazy, but yeah. Something here, you can look at the recent history, you know, a firm that has a lot of debt today, that could be rather beta's higher. You know, those are the kind of things you can think about. There's a lot of right answers. There's no one right answer. There are definitely wrong answers, and there is just making sure you're consistent. So we use a beta of 1.2. And we use a beta of 1.2. You just have to do the math. So you might try it yourself, make sure you're getting the right answer. So if you use 1.2, you should get a KE. Y'all can check me on this, 0.088. Anybody want to disagree with me on that? Let me know. But that should be your number. All right, any questions on that? So this entire thing is your answer. It's not really an essay question. It's not that much writing, so it's not horrendous, but that is your answer, right? No questions? All right. Then WACC. One thing that really help out on the exam is if you write the equations and then write them again with your numbers. I can give credit for math errors, but I can't give credit for math errors if I don't know what numbers you put in. If you're putting a bunch of things in your calculator and you have a math error, I can't give you credit for you accidentally multiplied by 0.5 when you meant to multiply by 0.6. I can't help you with that because I don't know what you multiplied by. So I would start with the formula, the weighted debt times the cost of debt times 1 minus the tax rate plus the weight of equity times the cost of equity. All right. The cost of debt equals the risk-free rate plus the spread. Cost of equity we already got. In the previous problem, the tax rate is the marginal tax rate is 25%. And again, I'm going to type that as 0.25. The weight of debt equals, well, the weight of debt is you take how much they have in debt, 42 billion, and 28 billion in equity. So 48 and 28. So you just have to do that math. So 48 divided by 48 plus 28. And weight of equity is going to equal 28 divided by 48 plus 28. Do that right, it should be 60%. And y'all hopefully are testing me here to make sure I get that correct. I'm not hearing any comments, so hopefully that's right. So the only thing we're missing here really is the spread. I mean, the risk-free rate plus the spread. So we'll go up here. And it says they have a 10-year bond issued 8 years ago. So it's a 2-year bond. And it's rated double B, triple B today. So that's all we care about. 2-year bond, double B. So 2-year bond, we want the 2-year treasury. So that's 4.05. And again, we're not going to type that as a decimal. As a percent, we're going to type it as a decimal. And our spread, so it's 2 years. We say triple B or triple B plus. I can't remember. Just triple B, no plus or minus. Okay, Carson? Yep.
Yeah, so when you were filling out the weight of debt and weight of equity just now, did you round to the nearest tenth or?
Well, I usually rig it so you don't need the round. So it comes out exactly at 60%.
Oh, okay. I have it at 63% and then 37%.
Yeah, it shouldn't be 63%. I'm not sure.
Maybe I did my math wrong. Let me look at it again.
Yeah, I mean, I try to rig it so that it does work out. I mean, you got 6 sevens divided by and 4 sevens. So 6 sevens and 6 sevens is 42, 4 sevens is 28. So you essentially have 6 and 4. So it should be exactly 60%.
I don't know. I did it on Excel. Maybe it's just being weird.
Yeah, it should come out. So yeah, double check, make sure on the exam, do it with a calculator. All right, so triple B, 2 years. So that's 88 basis points. I can't highlight that, but 88. So plus 88 divided by 10,000. That's going to equal 0.0405 plus 0.0088, which equals 0.0493. So then it's just a matter of plugging everything in. 0.6 times 0.0493 times 1 minus 0.25 plus 0.4 times 0.088. If you do all of that, you should get a WACC of 0.0574, right? Real similar to your Excel application 7. Any questions on that one?
Professor Sweet,
Yeah.
just a quick question about the exam in general. I'm assuming we have to bring our own calculator, right?
Yeah, bring your calculator because you're not using Excel except
Okay.
for questions 1 and 2.
Okay, thank you, thank you.
It can be scientific, financial, it doesn't really matter. There is an advantage on question 5. You have to do the entire problem, but your calculator could double check your valuation on the bond, but I mean, it's not required. I was tempted to make question 5 Excel, but I can't do too much Excel because we run out of time with too many students doing the Excel. So I just did the first 2. And I do actually like to see y'all work this one out. So for the bond, we got the face of the bond is $1,000. Our KD equals 0.0574. Our coupon equals $1,000 times. So let's go see what the coupon is. It has a coupon of 7%. So times 0.07, but we divide it by 2 because it pays twice a year. So that gives you a coupon of $35. And then we need our effective yield. And that's going to equal 1 plus 0.0574 divided by 2 raised to the second minus 1. You get a higher number than 574. And so, yeah, Carson, here's where rounding is an issue, but just go out 2 decimal places is fine. I get 499. You can just use 499. Rounding will put you off a little bit if you're doing it against your calculator. You can be off 8, 9, 10 pennies because of the rounding, but it just depends, but that's fine. And then you got to do the table. So the table is going to have, I'm going to insert a table. You can't do this on the exam, but it just looks better. So we're going to have time, cash flows, discount factor, and discounted cash flow. So we need 4. We need to have the title row, and then there's 4 payments. It's 2 years, but every twice a year. So that's 4 and 5. So you're going to have on your titles, you're going to have time first, cash flow second, which if you notice is the exact same thing you had on the cost benefit analysis. Then you have your discount factor. And then you have your discounted cash flow. So time is you get your first cash flow in 6 months, second cash flow in a year, next one in 18 months, and the last one in 2 years. Your first cash flow is going to be $35 because you just get the coupon. So cash flows are real simple on bonds, 35, 35, 35, and then at the very end, you get your $1,000 back and 35. Your discount factor is going to be 1 divided by 1 plus the effective yield raised the time. Here's where I would definitely go out 4 decimal places. So 1 divided by 1 plus 0.0499 raised to the 0.5, and that is going to equal 0.9759. And the next year you raise it to the 1. It's the same formula. You just use 1 for the second year and you should get 0.9525, 0.9296, 0.9072. If you go out 2 decimal places, rounding shouldn't be a big issue. That gives you a discounted cash flow. You just multiply across 35 times 0.9759. Again, with some rounding issues, but should be okay. 3334, 3253, and 938.94. You might want to look at it and say, okay, the coupon is 7%. The current market's only 5%. So this should be a premium bond. This is a great bond. It's paying you 7, everybody else is paying 5.7. So you should get something more than $1,000. So the value of the bond equals 34.16 plus 33.34 plus 3253 plus 938.94. And that equals about, kind of depends on rounding here, but it equals 1,38.97, 10, 8. That looks like that actually does round correctly. All right, so I want to see all of this. If you want to check in calculator, yeah, I put the WACC in there. That's my problem. So let's put, sorry, did I throw y'all off? So that's actually 493. Make sure your KD is what you're using for the bond, 493. So my fault. So 493, I should have saw it right there. Was someone going to point that out to me here? So obviously 499 has to be greater than that. So sorry, yeah. So if you put 493 in there, that should fix it. Let me try that again. So 0.0493 divided by 2, comma, 4 periods, comma, $35, comma, $1,000. And that gives me 1,038.97. So yeah, sorry about that. I picked up the wrong number. So yeah, be real careful for a problem. It's probably good I messed up so y'all can make sure you're careful on the exam. So be real careful. For question 5, use your KD, not your WACC. The WACC applies to stock and debt. KD is only for the debt. All right, so I'm kind of glad I did that. So you make sure you pick up the right number there. Any questions on that? So you need all of this. And this is optional if you want to in your calculator. You might try it. I mean, it's not good. It's not bad to have a backup to make sure you got the right answer, but that can't be your entire answer. You have to show me the table. I want you to show that you know what your calculator is actually doing and you're not just relying on technology to do this. All right, any more questions on 5? All right, this question's usually the easiest. Most people get this one right. So we got our KE, we said was 0.88. And so using that 0.88, 0.088, excuse me, we got to know what dividend 0 is. We have to know what long-term growth is. We have to know what short-term growth is. And we have to know what the H is, all right? So get in the habit of writing down what you need. So dividend 0, we can go back up and look at the problem. So let's copy this down and then I can delete it just so I don't have to keep going up and down. So their dividend 0 is 5.04. You see that right here. Long-term growth, 0.045. You see that right here. Short-term growth, your boss expects earnings growth to be 10% next year. Yeah, some of you on the, no, I think this is a paper in another class. They kept saying it's going to take 8 years for the growth to go from 4.5% to 10%, but it's the exact opposite. It's going to take 8 years for the growth, the decline from 10% next year down to 4.5%. So the 10% is the starting number. And then the H is that 8 divided by 2. Just remember it's half year. So that's 4. And so when you put all that together, you notice on the dividends, it says last 12 months. I don't switch that, but just for the fact exam, you need to know, is it the last 12 months or is it the next 12 months? So that can change how you do the formula. But the H model is set up for the last 12 months, and that's the reason I always do the last 12 months. The dividend discount model, it can go either way. So dividend discount model, it's going to equal dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. And then the H model is the exact same formula. So if you're trying to learn these formulas, the H model is not some radically different formula. You start with the exact same formula. I recommend, again, write the formulas out before you plug numbers in so you can prove you know the formula in case you get some just typos or something in your exam. So it's the same formula. We're just going to add this one little easy section in here, dividend 0 times H times short-term growth minus long-term growth. That's all we got to do. And so here we have 5.04 times 1 plus 0.045 divided by 0.088 minus 0.045. When you do that, you should get 122.48. Hopefully someone got that number as well. The H model, it's the same thing again, except for what's the parentheses? Some students really mess up on the parentheses. You need that entire numerator before you divide by KE minus long-term growth. Some students take this and they add this to it, but it's not that. You got to add all of this numerator before you do this. So be careful in your calculators. So here we're going to have 5.04 times 1.045 plus 5.04 times the H times 0.1 minus 0.045. That entire thing divided by 0.088 minus 0.045. And you should get a higher number than your dividend discount model because short-term growth is greater than long-term growth. So I get 148.27. I don't know if anyone can confirm those numbers, but it depends on what KE you used. It's possible in question 6, I might give you a different discount rate just so I don't have so many different answers. It depends, but it may be just like this problem. But so, I mean, it's possible. We'll see. All right. Any questions on that? All right. I'll keep going. So here we want to get economic profit for doing the economic value added, which is going to be accounting profit. And we're only doing 2 things. We're going to add back depreciation. And we're going to add back interest expense. Some of you on the application were grabbing the wrong numbers. So be real careful that you know exactly what you're grabbing. So the accounting profit is minus 27,000. Depreciation is 115,000. And the interest expense is right there, 51,000, 139,000. All right. Then we have our WACC. Our WACC is going to be cost of debt. Our cost of debt, she tells you up here, she borrowed at 8.5%. So 0.085, she borrows 600,000, and that gives you a cost of debt of 51,000. So that one's already given, but you can confirm it just by multiplying those 2 together. And then you have your cost of equity. Here she says 20%. And how much does she invest of her own money? 400,000. So that's going to equal $80,000. So your WACC is going to be 131,000. And your WACC as a percent is going to be 131 divided by $1 million, right? She invested $1 million, 600,000, 400,000. So that gives you a WACC of 13.1%. And your economic profit, call this return on invested capital, it's going to be 139 divided by $1 million. And that equals 0.139. So your EVA, your EVA equals your economic profit minus your cost of capital. And so when you do that, you're going to have 139,000 minus 131,000. And that equals 8,000 EVA. And your EVA spread equals your return on invested capital minus your cost of capital. That equals 0.139 minus 0.131, which equals 0.008 or 0.8%. All right. Any questions on that? Most of y'all had that pretty good on the application, except for some of y'all just hit the wrong line up here. When you just be real careful that you pull the interest expense. Don't get the wrong line up here. It's you only need really two numbers up here. We don't need revenue and expense. I have this one last comment. 225,000 is what she paid herself. That's just to throw you off. So just ignore that. All we're doing is depreciation. All right. Any questions there?
So we don't have to do analysis like we did on the assignment?
I don't think you really did an analysis on the assignment, did you? I don't remember. What analysis? I mean, this
Or
is
I thought you had to say like, oh, she did a good job managing or something like that.
I'm not looking for that. I mean, you can if you want to, but yeah, anything greater than 0, I'm not really looking for that here. But yeah, it's true. Anything greater than 0 is essentially the same thing as saying a positive net present value. But I'm not looking for that here. Just this is sufficient. You'll get full credit. All right, the last question, probably the easiest one, if you remember how to use a table. So I think on the application you use Excel. So here you got to be careful. So your risk tolerance here equals 0.008. So table value is going to equal 1 minus 0.008. So you're looking for 0.992. And so we're going to try to find 0.992. There it is in the table right there. Y'all see that at 2.41. So make sure you remember how to do the table. So you take your risk tolerance, subtract it from 1, because the table value is doing the right side, not the left side of the tail. The 8 is the left side. 0.992, that's 2.41. 2.41 standard deviations. And the next thing you need is just your value at risk. Your value at risk equals the mean minus number of standard deviations times your standard sorry, this computer has some serious issues. So that equals, what's our mean? Expected, remember mean is the same as expected return, so our mean is 0 minus 2.41 times, and our standard deviation is 2.4%, 0.024. And so when you do that, you should get a VAR of 0.0578. Your budget is 12 million, but your portfolio is 175 million. So your budget, so you can do it one or two ways. You can convert this in dollars. It's going to equal 0.0578 times 175. And that equals 10.12. I'm going to actually do it that way. Your budget is 12. So here you do need to say, so bar is in budget, so acceptable, something like that. So I just wanted you to know that you want your VAR to be less than your budget. If it's greater than, then you have to comment that they're violating your policy. They need to make some fixes, but here they're within tolerance. You should have done something similar to this in your stats class, so hopefully this isn't new stuff. If you want to do it in percentages, you can. To do it in percentages, then your bar equals 0.0578 and your budget equals 12 divided by 175. So in that case, you can do that because your budget is 0.0686. So it's the same thing. You can do it in percentages or in dollars. Either is acceptable. I think on the application, y'all all did it like this in dollars, so you probably want to just stick with that. All right, that's the last one, right? I took the Miller-Modigliani question out, so you don't have that one. So that's it. That's everything. Any questions on any of this? I'll put this file. Do y'all see any typos in my file? Any numeric problems? Probably not. Should be okay. So I'll put this file out there and I'll put the Excel out there as well. So you have them as part of your practice. All right. Any final questions?
Yeah, Professor Stewart, could you, is the schedule for, or the time for the test the same as the time for class or?
No, it's the official final schedule. It's 1 o'clock.
Okay, so we start at 1 p.m. for the final?
Yeah, 1 o'clock. Yeah.
And where are we showing up to again? Is it the FSC or?
No, it's in the classroom.
In the classroom still? Okay.
Yeah, it's the same classroom. So you have 2 hours. It's scheduled to go 75 minutes. So you shouldn't have any trouble. The only concern is the Excel. If someone gets really stuck on the Excel and takes way too much time, then I can't get other people on the Excel. So you want to make sure you're prepared to move. And you don't want to sit there for 20 minutes hoping it comes back to you somehow magically. Just if you don't know it, you don't do it and move on. So the first 2 problems are in Excel, but the rest of them are on paper. So most of y'all will start with the question 3 through 6, but it'll look very similar to this. I'm not going to throw any curves.
Okay,
Anything
cool.
else?
We're fine to bring our own computers and do Excel on those as long as you verify the
Your
document.
laptop, as long as the only thing you have open is this file right here.
Okay. Cool.
Any other questions?
So you said that you were going to send us that on an email, that little Excel file?
No, it'll be on Canvas when you get into class. So I'll load it on Canvas right when you get to class. And then as you get on your Excel, you'll log in to Canvas and pick it off from there.
All right, thank you.
And then you'll submit it. So you already be on Canvas, so you'll submit it on Canvas. I'll set all that up right before the exam. All right, I'll save this, put it out on Canvas, and then the video will be ready on our YouTube channel, hopefully by close of business today.